Special coverage from the New Orleans Investment Conference is brought to you by First Majestic Silver Corp. There's no substitute for silver. Hello and welcome back to Soar Financial, here from the floor of the New Orleans Investment Conference. My name is Kai Hoffmann. I'm the EdJR mining guy over on X, and of course, your host of this channel. And I'm excited to welcome back Danielle DiMartino Booth, founder, writer, brain behind QI Research. Danielle, it's great to have you back. It's good to see you in person.
Likewise, here in New Orleans.
Yeah, absolutely.
How are you?
It's absolutely exciting to be down here. A bit stressful to come down here with the TSA troubles, government shutdown.
I was only an hour delayed.
Oh, there you go.
It's like,
yeah.
You get off the plane and you're like, let me buy a lottery ticket.
Yeah, seriously, an hour and a half for me yesterday, but 2.5 hours going through TSA in Houston. I had a great time.
Wow.
Yeah, and I think I was the lucky one with 2.5 hours. My friends missed their flights, their teachers, so they're not at school today.
Oh my gosh. Okay, well.
We'll talk about the ripple effects maybe of the government shutdown.
Well, and there is that.
Or why don't we start with that, Todd? I was going to ask you about the Fed first, but let's start with the ripple effects of the U.S. government shutdown.
Well, I mean, every week that the government is shut down, you're shaving a little bit more off of gross domestic product. You're shaving a little bit more. You're adding a little bit more to uncertainty, and there was already plenty of uncertainty before the shutdown, and the fact that it seems to have taken a really ugly turn with this whole food stamps and is it going to be partially paid out, it has, to me at least, societal implications when you're talking about people missing meals. This is way more than politicking, and I'm surprised that neither side has kind of said uncle and stepped back, because this is, not only are we veering into record-long territory for a government shutdown, but really deeper implications economically and societally than we've ever seen in U.S. history.
How close are we to a resolution?
You know, it's really hard to say. I mean, but of course, there's a betting market for that. There's a betting market for everything. And right now, the gamblers are saying sometime after November the 16th. Yeah. So we're definitely going to, go at least past Election Day. Which is easy. That's tomorrow. But it looks like we could stretch into the middle of this month. I mean, you're pushing into U.S. holidays here.
Yeah, Thanksgiving is coming up. Yep. That's talking about TSA shutdowns and
what a mess. I mean, what a mess.
Going to be absolutely horrendous. One other outcome of the shutdown, of course, is a lack of data. And maybe that's a good segue into the Fed conversation here, because we're missing labor data, labor statistics, for example. How much of an impact is that going to have moving forward?
Well, it shouldn't have that big of an impact, but it certainly is giving Fed officials a reason, something to hide behind, to say we don't have enough in hand to make informed decisions. Forget the fact that before the BLS shut down, that 89% of U.S. economists said that they didn't have faith in the official data, and that most of us were already looking for alternative data sets to begin with to try and back up the lack of credibility coming out of official data sets. It's neither here nor there if Fed officials are going to hide behind it, to say we're driving in the fog, whatever analogy that they're going to use, because we have an overabundance of other sources of data that tell the Fed unequivocally that it is fallen down on its employment mandate.
Yeah, employment is rising, of course. 25 basis point cut. Another risk management cut, in your opinion?
Well, they certainly did couch it that way. I mean, I talk about dropping bombs on the market. And again, I think right now, Fed policy is being made as kind of a weapon of mass destruction against the administration, as opposed to monetary policy being made in terms of what's the best thing for the economy.
I don't have an overview, maybe a random question, but of the Fed board governors, like how are they constituted? Republican, Democrat? Is that
there are very few Republicans, and that is typically the case in all lines of public service when you're talking about the bureaucracy, if you will. Christopher Waller is a notable exception. Michelle Bowman is another exception. Chair Powell is an exception. Oh. Those are three. They were all appointed by Trump, by the way. But you get the sense with Myron being placed on the board that it is a matter of everybody else on the Federal Reserve Board against Stephen Myron. Yeah. Whether or not they have dovish or hawkish leanings themselves, it was quite incredible to see the wall of cohesion for his first meeting that was saying, we're going to stand together on behalf of Fed independence. Oh, wait, you're supposed to be back in the White House at your job in 3 months. Bye. So he really has been relegated to really irrelevance. And in fact, in this most recent meeting, October the 30th, there was a dissent that went the opposite direction of him, saying we should not have cut at all.
Like, it was Waller who surprised me the most, not at this meeting, but the last one before then. Because I thought, okay, he'd be on Marin's side. And he took a step back. He's like, no, we're okay, no cut. Or we shouldn't be cut, just 25 basis point cut.
But that was Waller not dissenting was a vote for Fed independence.
Yeah.
You have to look at it through that prism, because if one individual was able to be a political plant and be efficacious and gather support around his position as a clear representative of the administration, then there's something wrong with Fed policy. And there really is something at risk with Fed independence. So I understand what's happening. By the same token, there is an economy to shepherd, and it's not being.
No. Maybe last topic on the Fed is QT. We need to talk about quantitative tightening. I think we talked about it before, the 5 billion token amount of quantitative tightening every month that is going now to zero. They're giving us enough of a heads up.
Yep.
What is it? December 1st is the deadline date?
Let's see if overnight funding markets allow them to get to December the 1st, because they've been overnight funding rates have been going up. And if that was to continue, then that might be a signal to the Fed that there's not enough liquidity in the system for them to even wait until December the 1st.
Because I think banks are already tapping into the repo market there
They are.
as well, right? So
now this was designed. So all kinds of people on my formerly known as Twitter feed are like, it's QE. And I'm like, no, this is a standing repo facility. This was created for times when there was a liquidity vacuum, for there to be an established conduit to ensure that there's ample liquidity in the market. That did not exist in 2019. So it's a new tool that the Fed has to try and regulate liquidity in the overnight markets. I think what some people don't quite appreciate, though, is that the quantitative tightening on the mortgage-backed security side is not going to stop. So that's going to continue after December, and we'll actually see any proceeds from mortgage prepayments, and right now running 20 billion a month, funneled back into the Treasury market. So in that sense,
QE though?
In that sense, you could say that there's disproportionate roll-off effect in support of Treasury bills at the end of the day. Because it looks like that's what the Fed's going to be focused on.
Because Bessing is using the short-term lending market to fund the long end and keep the rates in check.
Right,
is my understanding.
And the Fed in turn is supposed to have a portfolio. Their balance sheet is supposed to mirror that of the Treasury. Yeah. So Bessing's kind of forcing the Fed into buying bills.
It's an interesting. I don't know. I'm coming up with a term I can't say publicly, but it's an interesting circle.
I know that term.
Can't say that, but it's very interesting. Let's talk a bit of the market, the effects the Fed has on the markets. What we're expecting here, the mortgage industry, housing market. Let's start there. Perhaps is very fragile. But what is the impact of maybe another 25 basis point cut, or even no cut in December here? If there's a lot of hope clinging on.
There is a lot of hope, but I think it's critical to appreciate what the Redfins and the Realtor.coms have said, and that's that even with the decline that we've seen in mortgage rates, it has not spurred the activity that we would hope that it would have. Meaning it's going to take a lot more than another 25 basis point cut to get the housing market moving, because it still remains so overvalued.
Deflation is the term that comes to mind, because we all know the Fed will have to cut again. So why not wait? Why buy a house in November when you can buy it in January for, let's say, 50 basis points less? And I'm making numbers up here.
You're not making numbers up, because in 30 years of data, we've not seen housing turnover as low as it is today, which means that the housing market is frozen. So you described something aptly, and right now there's two different reactions going on in the housing market. Either people are dropping the prices of the homes, or they're just pulling their houses off the market. And we're seeing that in droves, that sellers are saying, if I'm not going to get the price that I had in mind, because they're looking online and they're like, but Google tells me this is what my home is worth. But if they can't get that, then they're actually pulling their homes off the market. But you're right. In the end, the longer we wait, the longer the housing market is frozen, the more of a deflationary impulse we're going to see coming through the channel of shelter.
It's an interesting one, the housing market, because all my friends are looking for houses. Nothing is happening in Europe. That is, like there's nothing available either. What's the situation in the U.S.? Housing availability has always been a big topic. Is that changing at least a little bit?
So one of the relief valves has been that there's been so much construction, and we're actually normalizing back towards a more balanced market. Usually it's about 80% of the market is existing homes, 20% is new build. That got north of 30%. So now we're closer to 27% is new build. My point is the new homes that were constructed, that inventory was able to provide for the demand that was out there for lower cost homes. That's kind of drying up now. So we'll have to wait and see. But inventory is appreciably higher than it was a year ago here in the United States.
We always we discuss the macro to understand the micro. We're always looking for cracks in the system, and one I'm looking at, a big crack, is the auto subprime market, which is an interesting one because it feels like a lot of people are getting their loans unchecked. I'm not sure if they're spoofs or not on Instagram, where I see people paying down $2,000, but then 240 months in terms of maybe paying $1,000 a month and making numbers up again for an SUV that they shouldn't be able to afford. Okay, but the scenario is the same. Doesn't matter if the numbers are real or not. People are getting loans on cars that they shouldn't be driving and they cannot afford. Reminds me of a movie I've seen recently. You must have seen it as well, and we've all lived through parts of it.
We have.
Is that something we should be paying closer attention to with the tricolor now going down?
Yes, because we've not just seen Tricolor go, we saw Primalend go. That was another one. We saw one on the West Coast go just a few days ago. And the reason I say that others have followed is because when a crack emerges, you usually, if it's not an idiosyncrasy, if it's not a one-off situation, then you see other players start to fall. And one of the most interesting nuggets of information that I think we received as investors from Primalend is that they're seeing the fastest growth in auto delinquencies in their prime and super prime segments. So you mentioned $1,000 car payments, and that's become a regular, I think 1 in 5 car payments in the United States is $1,000 or more. It's, to paraphrase Bernanke, but in the opposite, this does not look to be contained to subprime. And the blowback through the credit markets, Tricolor may just be the proverbial tip of the iceberg.
Well, it's $1.7 trillion. So
it is.
That starts to fall over. The banks who are also involved in the subprime, they'll start, getting more aggressive on the credit card payments because they need to make sure that the money comes in. Is that a fair, pragmatic assessment?
That is what we're seeing with kind of the strongest lenders. They're tightening lending standards. They're cutting people's credit lines on their credit cards. We're seeing a huge increase in personal loans, and that means that a lot of people are taking out loans where they can get them, probably for very high rates, to consolidate their debts because they feel that they can't get as easy access to credit as they could before. Remember, the United States revolves on credit and credit creation. So whenever these things happen, there's less of a surprise that when you see a headline that says artificial intelligence is contributing more to U.S. growth than the consumer. It's a bizarre turn, but that's where we are right now.
Danielle, you're speaking here on stage as well in New Orleans. What's one of the takeaways that you want the investors to sort of walk out of the room with?
So, I think there needs to be a better appreciation for the blowback of what's happening in U.S. household finances into the broader credit markets and what the implications are for policymakers of the fact that less than 50% of the financial system globally is actually regulated. But what we've seen with First Brands and with Tricolor and with a third one that was associated with BlackRock is the problems are on the private credit side. But the conduit into the banking system fully exists. Well, there's your circle again.
Coming full circle.
Oh
my goodness.
That's what we wanted to say. That was good.
That was right. Danielle, really appreciate the conversation. It was always great to have you here.
Likewise, as always.
One last question, rapid fire. Where's the interest rate going to be in 6 months' time?
The 10-year Treasury?
Yeah, let's go with that.
I think you're going to see a lot of churning at the level, which is exactly what we've been seeing for months and months and months. There is a lot of disagreement on where rates are headed, and that's reflected in a market that, like the U.S. housing market, appears to be frozen, set in a range.
Awesome. Danielle, where can we send our audience to find more of your work?
So come to dimartinobooth.substack.com. Love to have you as a daily feather reader. If you run money for a living, if you're an institutional investor, come to QI Research, and we'll be more than happy to help guide your investing.
Fantastic. Awesome. Danielle, thank you so much for joining us here. Really appreciate it.
Of course.
Everybody else, thank you so much for tuning in. It is getting loud out here, and people are on break during sessions. Really appreciate you joining us. What do you think is happening? Are you watching the subprime auto market as well? Let us know down below. Thank you so much for tuning in. Hit that like and subscribe button, and we thank you for it. Take care out there.